because as commodities go up, the dollar goes down. And generally that has been true. Okay? Prior to 2007, the dollar was sold for 3 years. So what happens is, it's very simple, is these fellas have to cut their positions. The banks, the markets move so quickly that they're forced to liquidate their positions. And what they need to do is they need to close their positions, and they also are forced to close their other positions, and they have to go out and buy dollars. Okay? And also in terms of commodities, they also have to go out and buy dollars. So what happens is the reason why the dollar go bid, and then potentially in a crisis, the dollar is probably a sell if the US debt market goes bust, but purely on a liquidity basis, the dollar actually could go bid. But bottom line is it's a liquidity issue. So if there's a liquidity problem in the world, people buy dollars because, in my opinion, they have the most gold in their country, and it's still the reserve currency, and most things are denominated in dollars. So that is why the dollar can go bid, and definitely during times of turmoil, and that potentially could be happening. Why is gold going up? Because gold is basically, it's a quasi-currency. Because the dollar because the euro is so relatively weak, if you have Europe going bust and you have the States going bust, people are just going to have to look for something, So do you put your money in Japan? I don't know. No. Do you put your money in Switzerland? Yeah, you buy some Swiss francs, sure. But the other thing to buy is gold. It's yellow money. So you could actually see, and we've actually seen it, if you look at oil, for example, oil looks like it's very similar to equities. It's tried to retrace a little bit, and it's beginning to come off. You looked at stocks. They look very vulnerable at the moment too. They look like they had a good bounce, but in actual fact, I reckon that it's beginning, a bit like the euro here, beginning maybe another leg lower. But the one thing that does stand out is gold. That gold perhaps could go and break 1,600 and go higher and act in unison with the dollar, which would be very strange. Very strange. Very strange. But that in theory, the one thing about markets is, I think, one thing again, I'll come back to this swimming with the tide, driving the car. It's not our job to really guess what these macro events are going to happen. My advice to everybody is let them happen, but just participate. And I'll come back down. So I don't know what's going to happen with the US debt ceiling. I don't know whether the dollar is going to go up or it's going to go down. I don't really personally care. All I will be looking at is the same thing every day. Where did the market go? Did it break a certain fractal level? Is there going to be correction? Is there a confirmation? I'm going to get involved. Where can I put my stop? Is it safe? And again, the amount of money that I'm going to risk at the market, it's the same every day, or it's the same per trade. I'm in the same place. So it doesn't matter what happens in the world. So if I'm wrong, I'm wrong, but it doesn't change. So I don't know if that...
I'm just conscious that it's coming up to an hour and a half, and I could stay here all night, but I'm sure some of you have wives or something to go home to. So I'd love to we should take some more questions, and then we might just actually break, and you can talk to Gavan individually. So a show of hands. That gentleman behind the pillar there, yeah.
Thanks, Gavan. I just have two questions for you. One is, what personality, in your opinion, does the Swiss franc have?
The Swiss at the moment, the Swiss is probably a mixture between a grind and a corrective. But I would argue that it's the Swiss franc a bit like, it's the currency that is, it's the safe haven play at the moment. And the thing about the Swiss, it actually is a little bit like the British pound. It's breaking quite well, but when it corrects, it really whips back. So if you are short or you're long the Swiss franc against the euro or the dollar, if you see good profits, just take it, because just be aware the slightest good bit of news that will come out, it'll whip back on you.
Thanks very much. And the other thing was, I was just curious about your slide. It's more to do with, it was earlier on in the presentation where you talked about currencies that benefit depending on the risk that's out there.
Yeah.
And you said, like, when there's lower risk, the currencies that would benefit would be, you had the Swiss franc and the US dollar in the same category.
No,
did you not? Maybe I read it wrong.
Yeah, lash it up there. No, during lower risk, the dollar generally benefits, and that means that generally what you have is that you have lower equities and you have lower commodities. And in terms of the non-deflationary impact of commodities with the dollar, generally the dollar will appreciate as commodities go lower. When risk is on, people generally sell the Swiss and the yen. So let me just, so in terms of the, yes, that is correct. Let me just make sure that is correct. Low risk. Yes, that is correct. So for example, in terms of commodities and in terms of, so let's just say, for example, as the US stock market goes lower, okay, you'll generally see dollar yen go lower. Would you agree? Okay, people sell dollar yen. But what you'll also see is you'll also see the dollar increasing against the high yielding currencies, against the Aussie, and you'll see it against the euro, and you'll see it against the pound. So the yen and the Swiss behave quite differently from the dollar in this scenario. So what you want to do is if you look at the S&P and put up two charts, as it goes down, look at how the euro and the dollar perform, or dollar index in particular. But you'll find that dollar yen and dollar Swiss are the reverse correlation. That's to do with their low funding rates. Okay, thanks.
Okay. We're going to have to ration everyone to one question from here on. Down the back there, Des, please. Okay. Actually, Magic, I think you've actually asked a question already. Can we go for the guy?
Thank you. I'm very interested in the time periods you take to do your analysis. At the start of your talk, you talked about 15-minute curves, then 1 hour, and then at the latter end, at the end of your talk, you were looking at longer trends, and you talked about using a week. When you turn your computer on, let's say at the end of a week, just to get a feeling of what you do, you want to get a feeling of the long-term trend, which you take over a week. Then you drill down to a day, and then when you're in a trade, you're looking at the hour and the 15-minute.
Could I put it back to this in another way? Is that when you're cognizant of, let's go back to a little bit like the euro, okay? I know that at the moment that the big trend at the moment is corrective, so the prices are irregular and choppy, and that has been reflected in the shorter time frames, okay? So let's just say with respect to the euro, I'm trading it from that side, okay? But if I start seeing these fractals being broken and prices accelerating and behaving a lot more regularly and much more force that's a little bit different, that then will signify that there may be a trend change. And I will go back to my weekly chart and I will look at it and I will see, hey, in actual fact,
Would
there's
you
a
look for those fractals on a week, or sorry, on an hour, or like?
I would look at fractals up to 5 minutes.
Okay.
So, but
This is probably something we should. It's probably a one-to-one discussion afterwards.
And just one last thing: do you use moving averages? I notice you have a curve over them, which is a moving average.
yeah, I'll be honest. For tonight, you can. Moving averages are good. They're a bit like stochastics. They're historic. I think for tonight, I don't really use them that much. I find that if you use moving averages, people focus on the moving average and they think that this will do that. I just think if you can try to break it down to as simple as possible, it might give you a better understanding of what's going on in the price. I find some of the tools are good, but they're secondary. Does that make sense? And I think people can focus too many on the secondary tools, and that can avoid confusion and giving you bad signals.
Okay, I think we're losing the equity traders in the front row here are flagging. So I'm going to take last question. Was there anything up the front? Was there somebody? There we go. Des, up. Yeah, there.
It's just very simple. What currency pairs would you recommend following, and how many should you follow? Realistically,
I think realistically, I think for doing trades that you want to dip your toe into, and you want to get some exposure to the market, I would recommend dollar index. And the reason for that is it's a low volatility, but yet it contains all the components that you need for the higher volatility currencies. So it's a great way of doing small stakes, following the dollar, and also the dollar is completely responsive to commodities, so you get the whole feel of it. Okay, that's number one. And then what I would do is I would have naturally the euro for the euro and the dollar and all that. I would have probably something like euro Swiss. I'd have dollar yen, and I'd have the Aussie or the pound.
against the euro.
against the dollar.
Oh, against the dollar.
Against the dollar. I think that it's probably, I mean, you could trade Euro Oz, but again, there's a carry play there, and I'd only be afraid that the problem with the Euro Oz carry is if that blows in any way, you know, if you're starting off, you could have a bad experience. You could just get blown out. So you want to trade, what I would argue is you want to trade if you're starting off, trade very liquid instruments. So the euro is very, very liquid, but it's a highly volatile. It's more volatile than dollar index, but dollar index is liquid, and it's a very easy way to dip your toe into it.
Thank you.
Okay, Gavin is here for another half hour or so, so please do feel free to chat to him. I would like to thank him very much for a fascinating, I know we drifted on, but I thought it was worth it. Thank you very much for a fascinating lecture, and I would like to just thank him.